You are a beginner investor, or maybe you have some experience under your belt, but the question which ETFs to use to invest in is still valid, right?
That's right.
By the way, if you are totally new to the investing world, check out my previous video where I explain some basics like what ETF or management expense ratio are and establish some ground rules for successful investing. But back to the topic, which ETFs to use? Like seriously, there are almost 9,000 ETFs globally. How do you choose which to invest in?
It's too much! It's too much!
Hi, my name is Mike, and on this channel I'm showing you how much you can achieve by investing only $100 per week. Real money, real numbers, my real journey. Let's go!
Buckle up.
In this video I will reveal which ETFs and why I have chosen for my portfolio, as well as the strategy I'm gonna use for investing in those ETFs.
Here it comes.
Many investors consider S&P 500 index as the reference point. The S&P 500 is the index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. And there is a number of ETFs that track this index. One of the most famous is VOO from Vanguard. It has very low expense ratio, 0.03%, and since the beginning of this year it grew over 15%, which is great. Over the last 5 years, it grew over 87%. It is a great choice if you invest in US dollars. For Canadian investors, there are ETFs that track the same index, but in Canadian dollars. One of them is ZSP from BMO. And if we compare the performance of these two, VOO versus ZSP, you can see depending on the fluctuation of the exchange rate between Canadian and US dollars, but in general, pretty much the same thing. Its expense ratio is slightly higher, 0.09%, and it's a great option for Canadian investors. However, I would prefer a different one, and I'll show you why. The ETF from Global X, ticker HXS, also tracks the same index, S&P 500, and it contains the same companies. But if we check the performance, we'll notice that it is higher than ZSP. Why is that? It is because HXS doesn't pay dividends. But how is it possible? The companies that it contains do pay dividends, and ZSP pays those dividends to the shareholders. HXS reinvests the dividends into the same stock, so the fund grows without paying dividends, but the price appreciation is better, what we can see on those graphs.
So?
It is better for Canadian investors for the tax reasons. Say if I invest in this stock within my TFSA, which I'm doing on this channel, I do not pay any taxes from the price appreciation or from Canadian dividends. But from American companies, I have to pay 15% tax on those dividends. With HXS, there is no dividend, there is no tax, and for the price appreciation, there is no tax as well. So for Canadian investors that invest in TFSA, HXS is a better option than ZSP or any other ETF that tracks S&P 500 index and pays dividends.
Okay, I've got it.
Alright, S&P 500 index grew really well this year, but also there are companies that grew even better than that, and it would be a mistake to miss that opportunity. For this reason, I have chosen the second ETF for my portfolio, and it's gonna be a growth ETF. If I was to invest in US dollars, I would have chosen SCHG from Schwab. If we compare its performance to VOO, which is this line there, SCHG shows much better growth. Another popular growth ETF is VUG. It is also better than VOO, but not as good as SCHG. So if I had US dollars to invest, I would definitely invest in SCHG. But for Canadian investors, it would be better to have a similar performing ETF consisting of pretty similar companies, but listed in Canadian dollars. And such an ETF exists. It is ZNQ from BMO. If we check the graph, it goes really close to Schwab. So I'm gonna choose this one. Its expense ratio is 0.39%, which is higher, but it's still worth it just because of the high return that provide growth ETFs. If we look at the performance for the last 5 years, it delivered on average 21.89%, which is a really great return. If we compare holdings for SCHG and ZNQ, we'll see that they both have almost 50% exposure to technology, around 13-15% to communication services, and even top companies are pretty much the same. However, if you prefer greater exposure to tech, there's another ETF I want to note here. It is called Tech from TD, the Global Technology Leaders Index ETF. It is heavier on technology. Almost 2/3 of it is technology companies, comparing to only 50% for ZNQ or SCHG. That means a higher volatility because technology companies tend to be more volatile than anything else. They're gonna be growing faster, but they're gonna be falling faster as well. So it's up to you whether you prefer a slightly higher risk for better returns or staying safe with an ETF that has a smaller exposure to tech. You can see that ZNQ is pretty close to SCHG, while tech provides higher returns. So for now, there are two ETFs in our portfolio. One that tracks S&P 500 index and provides a great base for the portfolio, and another one that carries more risk but provides better growth.
So far, so good. Then what?
I would like to balance the higher risk of the growth portfolio with the dividend part of my portfolio. Dividend stocks are normally not as volatile as growth stocks or just S&P 500 index. They do not grow as much, but at the same time they do not fall as much. And on top of that, they pay higher dividends every month or every quarter. If I was to invest in American dollars, I would have chosen SCHD. I think it's the most popular dividend ETF these days, and for a good reason. It has really low expense ratio, just 0.06%, and the historical returns are really great. However, for Canadian investors, again, I wanted to find something similar in allocation and returns. One of the most popular Canadian dividend ETFs is VDY from Vanguard. Its expense ratio is 0.22%, which is okay for these kind of ETFs, and the historic growth is also good. Over 12% annually on average for 5 years, and over 7% for 10 years. Another popular Canadian ETF is XEI from iShares. It has similar management expense ratio, 0.22%, and it shows decent annual returns over the last 5 years and 10 years. Yes, these returns are lower than for S&P 500 index or the growth ETFs, but that is expected. As I said, dividend-paying companies normally do not grow as much and do not fall as much.
It's reasonable. It sounds reasonable. That sound reasonable to you? Yeah.
If we take a look at holdings for VDY, we can see that over half of it is the financial services, mostly Canadian banks like Royal Bank of Canada, TD, BMO. It is also heavy on energy companies, and together financial services and energy give over 85% of this ETF. XEI is not as heavy on energy and financial services. You see, combined they account only for slightly over 60%. It is also more evenly distributed among individual companies. As you can see, the biggest position is slightly over 5%, while for VDI the biggest position is over 15%. And there is another ETF I wanted to mention, XD from iShares. What is interesting about it is that it only contains companies from 5 industries. It doesn't have any real estate companies, basic materials, technology, industrials, unlike XEI or VDY. So it's heavily concentrated on these 5 industries. For individual holdings, the maximum allocation is smaller than 10%, which is greater than XEI, but better than VDY in this aspect. Its expense ratio is 0.11%, which is twice as low as XEI and VDY. And for annual performance, it is higher than XEI but lower than VDY for 5 years, and there is no data for 10 years because this is a relatively new ETF. For my portfolio, I'm gonna go with VDY just because it has higher returns than those two and better diversified than XDIV. So that's it. Those are 3 ETFs I have chosen for my portfolio. One ETF that tracks S&P 500 index, another ETF for better growth, and the third ETF for dividends.
That was great. I was really impressed.
In my previous video, I set up automatic contributions to my TFSA account. So by this time, I have collected some funds there, and in my next video, I'm gonna be investing them in these 3 ETFs.
Awesome, can't wait.
If this video was useful for you, hit the like button. And if you want to follow my investment journey, hit the subscribe button. Remember, on this channel you can see my real-life journey with investing, starting from zero, investing small, investing smart, and watching my money grow in real time. See you in the next one.